All right, everyone, welcome to this week's Sunday macro wrap-up for Sunday, June 22nd. Getting right into it here, I'm sure you guys have seen already, the past 24 hours have been quite interesting in terms of the geopolitical landscape. And so, we're not going to get too bogged down with that. Obviously, this is a tailwind for oil, as well as commodities, as well as in turn, also a tailwind for bond yields, right? And so, this is similar to the fear that the Fed was having with, tariffs, as well as this geopolitical risk with the rise of, oil prices, right? That's part of the reason why inflation has been coming down a lot over the past several months, is because oil prices have been coming down. And now that they are reversing, that's obviously going to be more of a tailwind for inflation, not so much a headwind there. So, yeah, just taking a look at everything happening over the past, several hours here. The world is pretty much just waiting for any type of retaliation from Iran. And so, yeah, the global stage is accelerating here. So we'll see how that plays out there. Last week, we also had a rate decision by the Fed. And so, before we get into this as well, for those people who are joining us for the first time on the Sunday Macro Wrap-Up, the way that it works is that the first 30 minutes it's streamed on our socials. And then the last 30 minutes or 45 minutes, we take it offline just for our Macro Optics members. And so those members are on the call right now on the Zoom. So if you guys want to take part of that, you can go to the links in our bios in the description below, and you can start a 7-day free trial so that you can join. We'll be going over some actionable ideas as well as some more data as well. But getting right back into it here, the interesting thing that I saw about the Fed meeting this week is that when we take a look at the SEP, or the Summary of Economic Projections, we saw that there was more Fed members who are saying that they don't expect any rate cuts in 2025, right? And so I believe that went from 3 members to 7, which is a pretty large change from the last meeting. And then I believe the market currently has 2 rate cuts being priced into the market for this entire year. But as the trend is showing, we could have no rate cuts in 2025. So we'll see how that shakes out. Currently, the target rate probabilities for the July meeting, still an 83.5% chance that they remain paused. September is showing nearly a 60-30% chance that they cut by 25 basis points. So that's what it's showing there. But it is interesting how there's more Fed members becoming more hawkish. And so when you zoom into the different changes in the economic projections, you can see pretty much in this table here, just look at this median one. And then for 2025, it's this first row here, right? So the change in real GDP, so economic growth, the March projection was 1.7, and that declined to 1.4. The unemployment rate is ticking up. They have PCE inflation going from 2.7 to 3.0, and core PCE inflation going from 2.8 to 3.1. So this is quite an interesting SEP, as they have growth slowing as well as inflation rising, which is something that we've been talking about on this channel for quite some time in the stagflationary environment. And so, yeah, the Fed is recognizing this, and they're saying, hey, you know what? With the trends that we're seeing right now, with the uncertainty surrounding the geopolitical tensions, as well as still with tariff inflation because I know that it's already out of the news cycle, but tariffs are still in play, right? All these things is giving the Fed fuel to remain cautious. And Jerome Powell pretty much came out and said that they're going to be late on purpose, right? So they're no longer being, trying to look at the data dependent numbers, even though the data that they look at is lagging economic data. In any case, they're just openly admitting now that they're not trying to stay ahead of the curve. And if something breaks, unemployment rises, and things get really bad, then they'll come in with stimulus. But the thing is that they're going to wait for pain first before they act. And so, that is really something that my team and I have been, sharing with our members for quite some time. And, Wall Street was expecting something different. So that has changed, as well as we're starting to see a rise in volatility, a rise in uncertainty. And this is all just fuel for the Fed to remain paused where they're at. So this can be viewed as more of a hawkish rhetoric from the Fed. And, taking a look at the different scenarios with the yield curve, this is going from what's called a bear flattening to a bull flattening. And so when we take a look at, let me see if I can find it here. Yeah, so when we take a look at the yield curve here, what we have is ever since April of 2020, or April 22nd, we had a bear flattening, which is this red zone, which typically means that the 2-year yield, or the short end of the curve, rises faster than the long end. It's basically just fancy bond talk for saying that the Fed is getting more hawkish. But now the yield curve is signaling more so a bull flattening, which is when the long end of the curve, or the 10-year, slows down faster than the 2-year, meaning that the bond market is pricing in more of an economic slowdown. And so this is usually, early warning signals that, things are definitely brewing. And, typically you can have 3 different scenarios, but the typical scenario out of this type of yield curve flattening is a steepening when something breaks and the Fed has to come in and rescue, which is pretty much what they just told everybody last week, what they're waiting on. And so, the stage is set there. Taking a look at some of the other macro headlines here from last week, we saw that the New York Fed manufacturing index continued to slow further. So, a lot of people were hoping, economists were hoping that the manufacturing sector was going to have a more healthier rebound. We're not seeing that. We're seeing that alongside services. So we continue to get leading economic hard data that shows that, yes, the yield curve is correct, that it's, pricing in slower economic data. Retail sales year over year had a pretty decent slowdown from April to May. It went from 5% year over year to 3.3%. This is, the lowest level since October of 2024, a pretty decent drop from the past 6 months that we've seen. Philadelphia Fed as well remains in negative territory. So again, another large manufacturing leading economic indicator is showing contraction in the manufacturing sector. What's interesting too is that we continue to see a large slowdown in the housing market as well. So this is also something that's a first compared to the last couple years, where you're seeing a large, an accelerated slowdown in the housing sector in the United States, which is important because a lot of people, they hold the majority of their wealth in the value of their homes, as well as their retirement accounts, so 401ks, as well as their homes. If they're both going up, that creates a wealth effect where people look at the value of their home, they look at their stock account, they're like, hey, things are going good. I feel a lot wealthier, even though it's all illiquid anyway, but that still creates a psychological effect where they're going to go out and spend more and everything like that. And so if people are now seeing their home values decline or at least stall, or maybe houses in their surrounding neighborhoods are selling for less value, well, that's not great. As well as if you continue to have the stock market going down, even though it did have a rebound over the past couple months here from the April low, If you also have the stock market going down, then that's a double negative wealth effect, right? Which could spiral into something worse. And so we want to pay attention to both the leading economic indicators, the stock market, as well as the housing market. But it is interesting how we're starting to see more of a turn in all three of those this year. Lastly, we can take a look at the Conference Board's leading economic index. That continues to track lower, and this is something that has had a very large divergence from the coincident economic index, which is the black line here. Let me see if I can zoom in a little bit more. A little bit more. How's that? All right. So yeah, pretty much since 2023, the leading economic index has continued down lower, while the coincident economic index continues higher. And we really haven't seen a divergence like this historically, unless we were already in recession. And so what you have to think about, and we've talked about this a few times, but really there's two different types of market participants right now in the real economy. You have the top 10% of earners or people who own wealth in the United States. They make up over 60% of all the consumption. Whereas the bottom 50%, they've pretty much been in recession for, the past several years, right? And that's really what it's showing here in this graph. And so at some point, these alligator jaws are going to clamp down. I don't know how that's going to happen in terms of timing as well as magnitude, but you can just see as this gap widens, the potential energy increases, right? And so yeah, that's just something to keep in mind, along with everything that we're keeping track of. And then let's see, taking a look at the calendar this week, we have flash manufacturing and services PMI data that comes out tomorrow. We have a little bit more housing market data as well with existing home sales, housing price index for both the federal housing, the FHFA, as well as S&P Global. Also, as well, we have the Fed Chair Jerome Powell speaking at the semi-annual monetary policy event that starts on Tuesday. And so I wouldn't be surprised if we continue to get a reiteration of what he basically told us on Tuesday of last week. I'm sure a lot of the reporters are going to ask him about his thoughts on the Iran deal, and he'll respond saying that he's independent and he doesn't have any thoughts on it. Pretty standard and typical response that he always gives. But he's talking on Tuesday. Some other leading economic indicators, such as the Richmond Manufacturing Index, core durable goods, and then we have core PCE on Friday. So a pretty decent data dump week for macroeconomic data. And so not only that, but we have everything developing with this Iran, Israel, U.S. situation. And ultimately, when looking at the charts here, oil prices have obviously gone a lot higher, as well as just looking at commodity prices in general. It's the same thing, right? So this is the commodity index ETF, GSG. And so this is one thing that my team and I have been long and went bullish in our model once it broke above this level here around $21.85. And so since it went bullish in our model, it's up a little over 7%. Same with oil. Oil went bullish in our model on this candle right here. And so since then, it's up 17%. USO is the preferred ETF for oil exposure. And yeah, that's been performing pretty great. As far as, we can't control these things. Obviously, some people are uncomfortable with investing in things, if it's related to, bad, stimulus happening. But again, we can't control those things. For us and our families, the thing that we can do is preserve our purchasing power. Otherwise, it's just going to keep getting eroded away by inflation, as well as the monetary policy from the central banks that really are the ones running the entire world. And if you're not just investing wisely to preserve your purchasing power, then you're just going to end up losing for yourself and your family. So got to think of it in that lens. Gold continues, its bullish trend here, and yeah, it's near closer to the low end there, low end of the range here, and given the stagflationary environment, that's typically an environment that gold really enjoys. So we'll see, if it keeps going up there. Silver, copper not as much as silver, but platinum, all are having large price appreciations. These are typically leading economic indicators of inflation that my team and I look at. Bitcoin had a decent little correction here. It was able to have this crazy candle and come back up to around 100K. And so it still remains in bullish trend here, but Bitcoin could be providing some type of signal here if it does break trend, going to neutral here. So definitely paying attention to Bitcoin as a proxy of some early macro indicators. And then S&P 500 futures, I believe, did open. And so you're seeing a little bit of a bounce there. The S&P 500 remains in bullish trend. You have the green color of my bookshelf there in the background. And for those who are new to the channel, whatever color the bookshelf is, that is the current trend of the S&P in our model. So if it's red, obviously bearish, yellow, neutral, but it's green right now. So we still remain bullish trend on, we still remain bullish on the S&P 500 because the signal has not broken trend yet. We don't make any decisions based off of news headlines or anything like that. It's all math based, and that typically leads or front runs the news. So I think it was last week as well. There was a large data hack in Google, and so you saw Google had a pretty decent 2-day sell-off at the end of last week, and so. Yeah, I was buying some Google on this, so we'll see what happens. But I wouldn't be surprised. This has not broken trend at all. So even with this large sell-off, Google remains in a bullish trend. So we'll see what happens there. But that is pretty much the update that we have this week. The dollar still somehow remains in bearish trend, which that's pretty unusual when you have geopolitical tensions rising, oil rising, as well as rates remaining, where they're at. Typically, the dollar does well in that scenario. So this is also a unusual signal with the dollar in bearish trend with all this going on here. So that's pretty much all I'm looking at here in terms of the macro updates. Again, for those who are on the stream, if you guys want to join after we close out here to take a look at some of the more actual ideas that we have, as well as have a further discussion with our members, you can join using the 7-day free trial code in the description of our socials there. But for those who are on the Zoom call, stick around. We're going to go ahead and end the stream and get back to your questions. So I appreciate everyone on the stream for joining. Good luck out there this week. Stay safe, and we'll catch you next Sunday.